Are you a new trader feeling overwhelmed by the noise of the market? You're not alone. Starting in the world of trading can feel like learning a new language. And for many, it's easy to get caught in the whirlwind of technical jargon, price fluctuations, and strategies that seem too complex to comprehend. But here's the good news. You don't have to be a genius to succeed in trading. You just need to understand a few key principles and learn how to execute them with confidence. The biggest challenge new traders face is not the complexity of the market itself, but the fear and uncertainty that come with making decisions in real time. Every trade feels like a gamble, especially when you're just starting. So, how do you go from uncertainty to mastery? This guide is designed specifically for new traders looking to understand how to spot high-quality trade setups in real time without feeling overwhelmed or paralyzed by emotion. Whether you're trading stocks, forex, or crypto, the principles of identifying the best trade setups are universal. It's not about catching every move in the market, but about finding the ones that offer the best risk-to-reward ratio, allowing you to make smart, informed decisions. In this comprehensive guide, we'll walk you through the step-by-step process of live trading, breaking down what makes a high-probability setup and how to recognize it before you make a trade. From understanding market structure and identifying key support and resistance levels, to mastering candlestick patterns and refining your trading psychology, we'll cover the critical components that new traders must grasp to succeed. But we won't just focus on the technicalities. We'll dive deep into the mental game of trading, where the real battle lies. Emotional discipline, confidence, patience, and risk management. These are the factors that will determine your long-term success. By the end of this guide, you'll have the tools and knowledge to confidently identify trade setups, manage your risk, and develop a trading strategy that fits your personality and goals. So let's get started and take the first step toward mastering live trading, one trade at a time. Chapter 1. Introduction to Live Trading, Laying the Groundwork. A gripping intro that instantly pulls the viewer into the world of live trading. You sit down, fingers poised over the keyboard, and take a deep breath. The screen in front of you is alive with charts, prices moving up and down. The market is buzzing with potential, but beneath it all, something else is at play. It's not just about numbers, candles, or indicators. This is about you, your decisions, your psychology, the way you control your mind as the market moves. Welcome to the world of live trading. This isn't just another video where we go over theoretical setups and dry explanations. This is you, in real time, making actual decisions. It's raw, it's real, and it's all happening now. The pressure is on, the stakes are high. But that's exactly what makes it thrilling. This is where the rubber meets the road. You're about to experience what it's like to spot the best trade setups in the heat of the moment. As you watch the market unfold, it may feel overwhelming at first, but here's the truth. Every successful trader has been where you are now. The moment when you realize the market is bigger than you, and you feel like you're drowning in a sea of information. But you can learn to master it. As we go through this series, I'm not here to give you an easy path. There are no shortcuts. But together, we're going to strip back the noise, clear out the distractions, and build a solid foundation. It's going to take practice, patience, and most importantly, psychological discipline. This is live trading. Real setups, real-time decisions, and real emotions. Every trade you make, no matter how small or big, carries weight. And it's your mindset, your ability to stay calm under pressure, that will separate you from those who never make it. The key to success isn't just about knowing when to buy or sell. It's about mastering yourself. You've probably heard it a million times. It's all about the setup. But the truth is, a good setup is only half the battle. The real challenge lies in your ability to spot that setup amidst the chaos of the market. Can you stay focused long enough to identify a high-probability trade? Can you keep your emotions in check when your heart is racing and the screen is flashing green and red? I'm here to guide you through this, step by step, from the moment the market opens to the closing bell. Together, we'll dig deep into the psychological battles that every trader faces: fear, greed, impatience, and I'll show you how to turn them into tools that work for you, not against you. Every time I sit down to trade, I know one thing for sure. The market doesn't care about your emotions. It doesn't care how much you've studied or how many books you've read. The only thing the market cares about is how you respond to it. That's where the real work begins. Over the course of this journey, I'll be with you every step of the way, from identifying the best setups in real time to managing your emotions and making the most of your trades. You'll start to see the world of trading from a completely different perspective. But first, let's talk about what makes a trade setup the best one. The best trade setup. What to look for. When you're live in the market, things happen fast. A potential setup could flash in front of you, but if you're not tuned in, you might miss it. The best setups are like a perfect storm. They need the right conditions, the right timing, and the right mindset. There are a few core things to look for. In the next section, we'll dive into how to identify those setups. But for now, let's just say this. Clarity. You need to see the setup clearly. The market needs to give you a distinct signal, not a vague one. Context. A good trade setup doesn't exist in a vacuum. You need to understand the broader market context. What's the trend? Are there any news events or market catalysts influencing price action? Timing. This is where many traders falter. It's not about reacting to every move, but knowing when to act. And the only way to get this right is through practice. In real-time trading, you're often left with just moments to decide. The best setups don't wait around. If you hesitate, the opportunity could be gone in the blink of an eye. A brief word on fear and patience. Don't be fooled by the speed at which things happen. There's a fine line between fear-driven urgency and calculated patience. A great trader knows how to control both. They're not rushing, but they're also not hesitating when they see the opportunity. Chapter 2. The Anatomy of a Trade. How to Recognize a High-Quality Setup. The market has just opened, and the rush of fresh data floods your screen. The numbers flicker, the price action dances, and the noise feels overwhelming. But here's the key to surviving and thriving in the chaos. You need to know what to focus on. What does the perfect setup actually look like? Is it just a matter of waiting for the market to hit a certain level? Or is it about understanding why price is moving in a certain direction, what's causing it, and whether it's likely to continue? Today, we're going to dissect the anatomy of a high-quality trade setup, the kind that offers you the best risk to reward and allows you to step into the market with confidence. Step 1. Understanding market structure. Before we dive into specific setups, you need to understand market structure. This is the backbone of every trade. The price doesn't move in a straight line. It forms patterns, retraces, consolidates, and sometimes breaks out with a vengeance. You'll want to pay attention to the higher time frames, such as the daily, 4-hour, or 1-hour, because these give you the broader context. Are we in an uptrend or a downtrend? Is the market consolidating, or is it making aggressive moves? This larger view will help you understand where the market is most likely to move and which setups have the highest probability of success. Look at the structure of price movement. Higher highs, higher lows. The market is in an uptrend. Lower highs, lower lows. The market is in a downtrend. Consolidation zones. Price is moving sideways and the market is indecisive. If you don't understand the market structure, it's like trying to trade in the dark. You need this big picture to help you decide whether you're trading with the trend or against it. Step 2. Identifying key support and resistance levels. Once you have the broader structure in mind, the next thing you'll want to identify are the key support and resistance levels. These are the price points where the market has historically reversed or stalled. Support is the price level where demand is strong enough to push the price higher. Resistance is the price level where selling pressure is high enough to push the price lower. When the market approaches these levels, this is where the action happens. The price could either break through or reverse depending on the strength of the trend and market sentiment. Why is this important? Because these levels give you a clear context for potential entries. If the market is approaching a strong resistance level and showing signs of weakness, like a bearish candlestick pattern, this might be a setup worth considering. Conversely, if the market is approaching a support level and showing signs of strength, like a bullish reversal pattern, you might be looking at a buying opportunity. Remember, retest setups are often the highest quality trades. After a level of support or resistance is breached, the market often retraces to test that level before continuing in the original direction. Step 3. Candlestick patterns, the market's way of telling you its emotions. Look for candlestick patterns that signal the market's mood, such as engulfing candles. A strong engulfing pattern can indicate that the market is reversing its current direction. Pin bars. These indicate rejection at a certain price level and can signal a potential reversal. Doji candles. A doji can signal indecision. It's important to look for the follow-up action after a doji to confirm whether the market will break in one direction or continue consolidating. Understanding these candlestick patterns in conjunction with your support and resistance levels and market structure will give you the edge in recognizing when a setup is truly worth taking. Step 4. The confirmation process. Don't jump the gun. You've identified a potential trade setup. The market is either showing a reversal at a key support or resistance level or making a clean break. But before you pull the trigger, you need confirmation. This is where many new traders get caught, thinking they see a setup and rushing in too soon. Confirmation is about ensuring that the market is actually doing what you expect it to do. It might come from a few different sources. A break of a trend line, a momentum shift in the form of increased volume or price breakout, a signal from your indicators, e.g. moving averages, RSI, MACD. The more confirmation signals you have, the more confident you can be that the setup is worth taking. But be careful, not every setup will give you all of these signals. Sometimes you'll have to make a judgment call. This is the art of trading. It's about reading the market, taking educated risks, and knowing when to trust your instincts. Step 5. Risk management, the silent partner. While it's important to recognize the best setups, risk management is what will keep you in the game for the long term. Without proper risk management, even the best setups will be meaningless. The rule is simple. Only risk a small percentage of your trading account on each trade. A common recommendation is 1 to 2% of your account per trade, but this can vary depending on your personal risk tolerance. If your stop loss is hit, you lose the amount you've set, and that's it. No chasing after the trade, no trying to recoup losses. That's the beauty of effective risk management. You're in control of the potential loss before you even enter the trade. But there's more to it than just setting a stop loss. The position size, how much of your account you're risking per trade, will have a direct impact on your performance. If you risk too much on a single trade, a few losses in a row can wipe out a large chunk of your account. Chapter 3. Trading Psychology. Developing the right mindset to pull the trigger. You're sitting at your desk, eyes glued to the screen. You've spent hours studying charts, looking for the perfect setup. The moment has arrived. A potential trade is forming, and everything seems to line up. But as you reach for the mouse to enter the position, something happens. A small voice inside you says, "What if it's not the right time? What if I'm wrong?" It's a familiar feeling for every trader. The market can bring out a whole range of emotions: fear, doubt, greed, impatience. And if you let those emotions dictate your actions, you'll end up chasing trades or sitting on the sidelines while the market moves without you. In this section, we'll tackle the mental game of trading, the psychology that drives your decisions, shapes your actions, and ultimately determines your success or failure. The power of confidence, trusting your setup. Confidence is the foundation of successful trading. But confidence isn't about being 100% sure of every decision. It's about trusting in your process. You've done your homework, you've identified a high probability setup, and now it's time to trust yourself and take action. Why do so many traders hesitate? It's fear. Fear of losing money, fear of being wrong, fear of regret. But here's the thing, fear is part of trading. It's not something you can avoid, and trying to push it away only makes it more powerful. Instead, you need to acknowledge it, understand it, and use it to fuel your decision-making process. The best traders know that fear doesn't disappear. It's something they manage. They know that every trade has an element of risk, and that's part of the game. But fear won't stop them from acting on their strategy when the time comes. When you're sitting in front of the screen and it's time to act, remind yourself that the setup you identified earlier is based on sound principles. If it's a high probability setup, the risk is part of the process, and no matter what, you'll be learning from the trade. The role of patience, waiting for the right moment. Patience is just as important as confidence in live trading. Too many new traders rush into trades, trying to chase after the next big move or fearing they'll miss out on a profitable opportunity. This is the fastest way to lose money. The market will give you plenty of chances, but you can't afford to take every single one. The most successful traders understand the value of waiting for the right setup and only taking the best trades. Patience isn't about sitting there doing nothing. It's about staying disciplined. Even when the market looks volatile, even when price is moving all over the place, you don't need to jump in. Instead, you focus on the one or two trades that truly meet your criteria. The key question to ask yourself before entering any trade is this the best trade I can take right now? If you're uncertain, then it's probably a sign to wait. No trade is worth the anxiety of being unsure. Fear of missing out. FOMO, the trader's worst enemy. Every trader has experienced it. The market moves sharply in one direction, and suddenly you feel this overwhelming urge to enter. FOMO, the fear of missing out, can be one of the most destructive forces in a trader's psychology. When you give in to FOMO, you're making decisions based on emotion, not logic. You're trading on impulse, reacting to the market rather than responding to a carefully thought-out plan. Here's the truth. You cannot catch every move. The market is constantly moving, and new opportunities will always arise. Just because you missed one move doesn't mean you've missed your chance forever. To overcome FOMO, you need to remind yourself that there will always be another opportunity. The market is full of setups that meet your criteria, and if you missed one, there are plenty more waiting. Trust your process, and don't let the fear of missing out push you into bad trades. The importance of discipline, sticking to your plan. Trading without discipline is like driving a car without brakes. You might be able to go fast for a while, but eventually, you're going to crash. Discipline is what separates the amateurs from the professionals. It's about sticking to your plan, no matter how tempting it may be to break the rules. Every time you abandon your strategy or give in to a moment of weakness, you're sabotaging your own success. Discipline is about consistency. It's about following your setup criteria every single time and not deviating from it because of emotion or a fleeting desire to make quick profits. Ask yourself, have I followed my plan? Did I wait for the right setup? Have I followed my risk management rules? If you can answer yes to all of those, then you've done your job. The rest is up to the market. Managing your emotions, the trader's secret weapon. Let's be real, trading is emotional. Even the most experienced traders feel it. The rush of excitement when you're in a winning trade, the sinking feeling when you're wrong, the frustration of missing a big move. But what separates good traders from bad ones is how they manage those emotions. Emotions are a part of the process, but they shouldn't control your decisions. The market is emotionless. It doesn't care about your feelings or whether you're winning or losing. It will keep moving regardless of your emotional state. If you let your emotions dictate your decisions, you'll make impulsive choices that lead to poor results. The best way to manage your emotions is through routine and self-awareness. Take a moment to check in with yourself before every trade. Are you calm? Are you focused? If you're feeling too emotional, it's okay to walk away for a bit. Another key to emotional control is staying humble. Don't let a big win or a successful trade go to your head. Don't let a loss drag you down or shake your confidence. Stay level-headed, stay grounded, and stick to your rules. Chapter 4. Risk Management. Protecting your capital and managing drawdowns. The market is constantly throwing opportunities at you. You see setups, you spot the perfect trades, and you're ready to pounce. But there's a critical question you must ask yourself before every single trade. How much are you willing to lose? Because if you're honest with yourself, every trade carries risk, no matter how perfect the setup seems. This is where risk management comes into play. It's not enough to simply find a good setup and hope for the best. Successful traders know how to protect their capital and minimize the impact of any losses. The goal isn't to win every trade, it's to protect your account from large drawdowns so that you can trade another day. The key to risk management: defining your risk before you enter. Before you even enter a trade, you must define your risk. This is your stop loss. It's non-negotiable. Whether the market moves in your favor or not, your stop loss is the limit of what you're willing to lose on a single trade. This simple but crucial rule will save you from the emotional roller coaster of trading. Think about it. You could be wrong on a trade, and that's okay. Every trader gets it wrong from time to time. But what separates the winners from the losers is how they handle these losses. So, define your risk first. Ask yourself, if I'm wrong, what am I willing to lose? And then make sure to stick to that decision, no exceptions. Position sizing, the golden rule. Once you've established your stop loss, you'll need to determine your position size. This is how much of your trading account you're willing to risk on a single trade. There are several methods for calculating position size, but here's a simple formula to get you started. Position size equals account equity times risk percentage over stop loss in pips or price. Let's break this down. Account equity, risk percentage, stop loss in pips or price. This formula helps you calculate how much of your account you're risking based on your stop loss and risk tolerance. Example: let's say you have a $10,000 trading account. You're willing to risk 2% per trade, and you've placed a stop loss 50 pips away from your entry point. Your position size would be 10,000 times 0.02 divided by 50, which equals 4. So you'd be risking $200 on this trade, which is 2% of your account. The key takeaway here is this: always adjust your position size based on the amount you're willing to risk, not based on how much you want to make. Over-leveraging can quickly lead to large losses that can wipe out your account. The risk-reward ratio. What's your edge? Now that you've defined your risk, the next thing you need to evaluate is your reward. The risk-reward ratio tells you how much potential profit you're aiming for relative to the risk you're taking on a trade. For example, If you're risking 50 pips to potentially make 150 pips, your risk-reward ratio is 1 to 3. You're risking $1 to make $3. Traders often use a minimum 2 to 1 risk-reward ratio, meaning that for every dollar they risk, they want to make at least $2. However, don't get too caught up in perfecting your risk-reward ratio. Sometimes a high-quality setup might have a lower ratio, but it's still worth taking. The key is to be consistent and make sure that over the long run, your winners outweigh your losers. When you're managing risk, always ask yourself, is this trade worth the potential loss? A high-quality setup should always offer a decent reward for the risk you're taking. Setting stop losses, the art of protecting your capital. A stop loss is your safety net. It's your way of saying, if this trade goes against me, I'm out. The stop loss can be set based on a number of factors. Support and resistance. Place your stop just below a support level if you're going long, or above a resistance level if you're going short. This is a logical way to set your stop loss because the market would have to break through these key levels to continue moving against you. Volatility. Some traders set their stop loss based on the average volatility of a currency pair or asset. For example, if an asset tends to move 30 pips on average during a given period, you may set your stop loss just outside of this range to account for natural fluctuations. ATR, or average true range. The ATR is a technical indicator that measures market volatility. A common approach is to set your stop loss at 1.5 or 2 times the ATR, depending on the asset's behavior. Remember, don't make the mistake of setting your stop loss too tight. If your stop loss is too close to your entry, you might get stopped out on normal market fluctuations that aren't actually significant. On the other hand, if your stop loss is too wide, you could expose yourself to larger losses than necessary. Finding that balance is crucial. Your stop loss should protect your capital, but it should also give the market enough room to breathe. Handling drawdowns. Staying calm during a losing streak. At some point, drawdowns, a series of consecutive losses, will happen. It's part of the game. Every trader, no matter how skilled, experiences them. But it's not about avoiding drawdowns. It's about handling them properly. When you're in a drawdown, it's easy to panic. You may be tempted to change your strategy, risk more to recover losses, or force trades to make back the money you've lost. This is the most dangerous mindset to have. Instead, take a step back and remind yourself, drawdowns are temporary. Your strategy is based on long-term consistency, and you're not looking for quick wins. Stick to your risk management plan and don't deviate. If you find that your emotions are getting the best of you, it may be wise to take a break from the market for a day or two. The importance of journaling, tracking your performance. One of the best ways to stay on top of your risk management is by maintaining a trading journal. This journal will help you track your trades, learn from mistakes, and fine-tune your approach. Every time you make a trade, log the following: the setup you were targeting, the reason for entering the trade, the position size and stop loss, your emotional state before, during, and after the trade, the result of the trade, win or loss. By reviewing your journal regularly, you'll notice patterns in your behavior. Maybe you'll see that you tend to risk too much when you're feeling overly confident, or perhaps you realize you've been neglecting your stop loss placement. Journaling is a great way to hold yourself accountable and refine your risk management strategy over time. Conclusion. By now, you've learned the core concepts of recognizing high-quality trade setups in real time, from the fundamentals of market structure and identifying key levels to mastering candlestick patterns and understanding the mental game behind trading. But this is just the beginning of your trading journey. The market is vast, dynamic, and full of opportunities, but it's also full of risk. The real key to success isn't just about finding the perfect setup, but also about managing your emotions, developing discipline, and sticking to your plan. As a new trader, you'll face challenges. There will be losses, there will be mistakes, and at times you may feel the urge to give up. But don't be discouraged. Every great trader started exactly where you are, learning, struggling, adapting. Remember, it's not about being right all the time. It's about having a consistent edge, sticking to a process, and managing risk in a way that allows you to grow your account over time. The most successful traders are those who can take a step back, evaluate their decisions, and refine their approach with every trade. As you gain experience, you'll develop your own unique trading style. You'll learn to trust your instincts, make quick decisions under pressure, and most importantly, stay calm and collected no matter what the market throws your way. Trading is a lifelong journey of learning and adapting, and the best traders are always students of the market. So as you begin to apply the lessons from this guide, remember, don't rush the process. Focus on building strong foundations, stay patient with your progress, and keep a mindset of continuous improvement. In the end, success in trading isn't about luck, it's about understanding, discipline, and persistence. The more you commit to these principles, the closer you'll get to achieving your trading goals. So, go ahead, put your knowledge into action, trust your process, and take control of your trading journey. The market is waiting, and so is your next trade.